This is going to be a very quick lecture because we are not going to use any other double candle pattern. We have seen the bullish and the bearish engulfing pattern, tweezers top and tweezers bottom, the dark cloud cover and the piercing pattern, so you have a lot of double candle tools to face the market. I'm showing you very quickly the Harami, but we are not going to use it because it is not useful in the Forex market. The reason I'm showing the Harami is because it is very popular and you will easily find it in any book or guide about Forex trading. So I don't want you to leave a bad review saying the instructor didn't teach me the Harami. Just joking. There are other double candlestick patterns that we are not going to see because they are useless in the Forex market. So you have enrolled in this course, you have invested money, but above all time. And I think that the best way to repay you is to filter between good and bad patterns without wasting your time. That being said, the Harami is another gap pattern. That means that it needs a gap between the two candles. Here we have a bullish Harami. The first candle is in line with the previous downtrend. Then there is a gap high that is not in line with the previous trend. So the gap high is the first clue that sellers may lose their power. The second candle is a candle with a very small real body, ideally a doji. The second candle confirms the suspects that traders already had after the gap high. Sellers are losing power, and now the battle between buyers and sellers seems equal. Here we can see a bearish Harami. Of course, the logic behind is the same, but this time it appears after an uptrend. We are not going to use the Harami for two reasons. The first reason is that it is very rare. You will have hard times if you try to find the Harami pattern in one of your charts. The second reason is that if you think about it, you don't really need to know the Harami to understand that the market is in a period of uncertainty. The second candle is already a candle with a very small real body or a doji. So the second candle by itself expresses indecision, just like we have seen for the doji. We also have other double candle patterns, most of them with a gap in between, like the upside gap two crows that we see here. This is like an inverted Harami, and in the stock market is used more or less in the same way we use the bearish engulfing pattern. I'm stopping here talking about the double candle patterns. I could talk for hours, but we need to follow our path. So I hope you are excited to start the next part of the course. We are going to study the triple candlestick patterns, and then we are going to face the market with all we have studied so far. There are so many three candlestick patterns. If you buy any book about candlestick patterns, I'm sure you will find at least 6 or 7 free candlestick patterns. There's the morning star, the evening star, the morning doji star, the evening doji star, free black crows, free advancing white soldiers, and many others. Trust me, I know all of them. I have also published a guide in Italian about candlestick patterns years ago. It is very hard to surprise me with a candlestick pattern that I don't know yet. But it is just because I know these patterns that I'm not including them in this course, because I know that they are not useful for your trading. My job as instructor is not to provide you with the longest course just to say that I'm cool. My job is to see you succeeding as a Forex trader, so I'm going to show you only successful candlestick patterns. Anyway, you can Google them. You have arrived so far, so I'm sure you have a great understanding of the price action, and you will probably arrive at the same conclusions that those patterns are not useful for your trading. Having said that, We are going to study two powerful signals, the rising and falling 3 method and the master candle. The rising 3 and the falling 3 method are both continuation patterns. Even if many times they are introduced together with other triple candlestick patterns, they are composed of 5 candles. The number 3 in their names refers to the market phases that this pattern shows. Let's start with the rising 3 method. The first phase is composed of a long green candle that confirms the uptrend. Then we have 3 falling or lateral candles that hold within the long green candle's high-low range. Ideally, we have 3 red candles with a small real body and small shadows, but it is still acceptable if one of these candles is green with a small real body or a doji. This second phase is showing a period of rest from the battle between buyers and sellers. Usually traders say that this is a consolidation phase after a strong trend. Last phase shows a strong green candle that closes above the closing price of the first candle. This means that the market is forming a new high and the uptrend is still there. What about the falling 3 method? Well, it's just the bearish counterpart of the rising 3 method, so this time we will see this pattern during a downtrend. Analyzing again the 3 phases, we have a first phase with a long red candle that confirms the downtrend. Then we have 3 rising or lateral candles that move inside the high-low range of the first candle. Once again, the ideal situation is to have 3 small green candles, but it is fine if one of these candles is a doji or a red candle with a small real body. This second phase is a consolidation of the market. Sellers are not pushing the price any farther, and buyers don't seem to have the power to react. You can also expect that the trading volume during this period is very low. It's like that sellers and buyers are playing a chess game and they are both thinking about their next move. At the end, we have a long red candle that closes below the closing price of the first candle. The market has a new low and the downtrend is still on. This chart shows pound against dollar, 4 hours is the time frame. This is a perfect example of a falling 3 method. We can see that the first candle confirms the downtrend, then we have 3 small candles within the range of the first candle. This shows that what buyers achieved in 3 sessions is less than what sellers achieved with just 1 session, that is the first candle. Last candle of this pattern shows that sellers are again on the market, pushing the price down, so the downtrend continues.